Welcome back to Alpha Recap. Brittany here, and we're breaking down the market moves after the close. As always, if you have questions, you can reach us at stockalpha.ai. Today was one of those risk-off days driven by an oil shock and a bunch of sector-specific headlines. So, let's dig in.
Thanks for having me. There was a lot to unpack after the close. It wasn't a broad sell-off so much as a rotation out of smaller, more speculative names and into perceived safety.
Give us the snapshot first. How did the major indexes finish?
Sure, and the number that really caught our eye. The S&P finished the day down about 0.5%. The Nasdaq finished down about 0.3%, and the small cap index fell about 1.9%. That small cap move was the clearest signal.
So, what really stands out here is the divergence. Big name tech held up better, while small caps got hit hard.
Exactly. When you step back and look at this, it was a classic reallocation. Quality and balance sheet strength outperformed, and liquidity-sensitive small cap names got repriced lower.
Walk me through the drivers. Was it just oil, or were there other things at play?
It was a few cross-currents. First, oil headlines pushed crude higher intraday. Supply disruptions and geopolitical concerns reintroduced inflation worry. That's important because higher energy can lift earnings for energy producers while squeezing margins for transportation and consumer companies. Right. And the other thing is a bunch of idiosyncratic corporate headlines across healthcare, financials, crypto, and industrials that added to sector rotation.
And that rotation showed up where?
Investors moved into energy and parts of utilities, especially solar and storage names, and into certain large-cap consumer and financial names that looked resilient. Meanwhile, cyclical and rate-sensitive small and mid-cap names were marked down sharply. Not a great day for illiquid names.
Yeah, that tracks. Quick reactions. Was breadth poor across the board?
Breadth deteriorated. The headline indices were somewhat held up by a handful of mega-cap winners, which is why the Nasdaq's decline was milder than the small-cap rout. But underneath, participation was weak. Classic late-cycle risk aversion.
Let's go sector by sector. Start with energy and utilities.
Energy was mixed, but overall constructive. Traditional oil and gas names benefited from higher crude, while renewables continued to get attention as project economics improved for solar and storage. Utilities traded as a relative refuge. Investors favored cash-yielding, regulated models and companies tied to electrification and grid upgrades.
Materials and industrials. Anything notable?
Materials were mixed. Some metal names had selective strength on supply narratives, and strategic mineral stories, think rare earth plays, caught interest. Industrials were choppy. Tariff talk, spin-off news, and a few strong deals created pockets of demand, especially for capital goods tied to infrastructure.
Financials?
Complicated. Banks felt pressure on macro uncertainty and potential loan loss repricing after the oil move, but select financials, credit card issuers seeing strong premium product demand, showed resilience. So, it was a mixed tape.
Consumer, media, and real estate?
Consumer and retail were muted overall, sensitive to higher energy costs, although there were company-specific bright spots in discretionary. Media and communications were mixed too, pockets of ad strength offset by distribution concerns. Real estate remained cautious. Policy risks still kept investors a bit wary of REITs and operators.
What about crypto-related names? That space has been volatile.
Crypto-linked names were under pressure after miner stress and uneven commentary on Q4 for one of the big crypto exchanges. That pressure in miners and exchange-related stocks fed into broader risk assets because those names are high beta and lead sentiment at times.
Short reaction.
Right.
Let's hit some of the individual movers. Who stood out on the upside?
Biotech had pockets of strength. One company saw early regulatory approval for a program and rallied. That kind of single-name catalyst can move a stock independently of the tape. Another genomics name posted stronger than expected results and signaled stable demand for sequencing tools, which was a nice bright spot in healthcare. And in payments, a major card issuer reported strong demand for its premium card products, which highlighted strength at the high end of consumer spending.
And the downside names?
Crypto exchanges and miners were pressured, as we said. The miner complex faced selling because margins are squeezed and network pressures persisted. Also, a cluster of regulatory filings, just a string of smaller filings, sparked micro volatility in a handful of names. Finally, a small home builder got spotlighted by an activist fund, which tends to move smaller cap residential developers in choppy markets. Small caps really felt every headline today.
So, what did this mean for the Fed and macro outlook?
There were no major macro prints today, but the inflation story mattered because of oil. Higher energy prices complicate the Fed's job by keeping headline inflation elevated, which could delay the market's expectation for rate cuts. Investors will be watching upcoming CPI and PCE readings and any Fed commentary closely. If services or wage inflation showed reacceleration, that would likely keep the Fed cautious.
I mean, when the market starts pricing policy risk differently, positioning changes fast.
Exactly. Positioning tightened, especially among managers with exposure to small caps, which can exacerbate moves in less liquid names.
On the technical side, what should traders have been watching after the close?
Technically, the market probed recent swing lows and small caps underperformed decisively. The comm and the mega cap tech names masked poor breadth. Traders should have been watching support levels on the S&P and whether the Nasdaq could maintain relative outperformance. The key technical red flag would be continued failure of small caps to find buyers. That could accelerate a broader correction.
Short reaction.
Understood.
Okay, outlook. What to keep an eye on into the next session?
5 things. 1. Oil price action. Continued upside keeps pressure on margins and inflation expectations. 2. Fed speakers and the economic calendar. Hawkish nuance would extend the risk-off move. 3. Crypto and miner headlines. If miner stress continued, expect volatility there. 4. Earnings and company-specific catalysts. Biotech approvals and strong results can still lift single names. 5. Breadth and small cap action. If small caps stabilize, defensive positioning could unwind quickly. If not, expect consolidation or a deeper pullback.
Trading implication in plain English?
Short-term traders should respect the risk-off bias and protect the downside. Tighter stops, hedges, fewer long-only bets in small caps. Longer-term investors should view selective weakness as an opportunity to add to high-quality names with durable cash flows and healthy balance sheets.
Final takeaways?
Headline risk can shift positioning fast. Even though the S&P and Nasdaq only fell modestly, the almost 2% drop in small caps told the real story. Risk appetite is fragile, and liquidity-sensitive names get sold first. Energy and defensive utilities outperformed, while growth and crypto-linked names saw selective weakness. Watch commodities, Fed language, and breadth for the next directional cues.
Great summary. I'll add one quick practical point. If you own small caps, check your exposure tonight and think about liquidity before the next session.
Yeah, absolutely.
All right, that's our recap after the close. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening. We'll see you next session.